global markets could soon face a significant upheaval as Japan begins reducing its holdings of U.S. Treasury bonds, raising alarms in Washington. Heightened tensions over tariffs, particularly targeting Japan's robust electric vehicle industry, are prompting Tokyo to explore bold financial responses. Could Japan's strategic bond sell-off threaten U.S. economic stability? Or is this simply a calculated move for greater leverage in trade negotiations? Context and background. On March 1, 2025, the Japanese Finance Ministry issued a statement highlighting the importance of investment diversification, interpreted as signaling an exit strategy from U.S. bonds. Washington swiftly condemned this action, emphasizing trust between allies and cautioning against destabilizing the dollar system. Historically, Japan has been among the largest foreign investors in U.S. debt, making this a particularly impactful development. Recent friction has been exacerbated by U.S. tariffs targeting Japan's electric vehicle exports. Japan, a global leader in automotive innovation with giants like Toyota, Nissan, and Honda, sees these tariffs as unfair protectionism. In private, Japanese officials have reportedly discussed the possibility of reconsidering their bond investments as leverage in trade disputes. Japanese investors have traditionally been instrumental in financing U.S. budget deficits, helping maintain low borrowing costs. Any significant reduction in Japan's bond holdings could challenge the U.S. financial markets, increasing interest rates and potentially slowing economic growth. Japan's Treasury bond strategy. Japan's shift away from U.S. bonds is significant because of its potential to weaken the dollar's international standing. American headlines have expressed alarm, framing this as Japan pulling the dollar mortgage. With electric vehicles central to the global economic debate, U.S. tariffs have angered Japanese manufacturers, prompting Tokyo to question why it should financially support U.S. interests through bond purchases. The Japanese finance minister recently indicated that unilateral U.S. sanctions would trigger alternative economic responses. Analysts warn, however, that a large-scale bond sell-off could create volatility, affecting not only the dollar but also causing the yen's value to surge, potentially harming Japan's own economic stability. Japanese policymakers are aware of these risks and have signaled a cautious approach. Financial experts speculate that Japan's strategy involves gradual bond sales rather than abrupt divestment, minimizing immediate disruptions while maximizing diplomatic pressure. U.S. response and potential countermoves. Washington, facing inflationary pressures and economic growth challenges, has reacted cautiously but sternly, stressing that allied trust and interdependence should prevent abrupt economic actions. Behind closed doors, the Bank of Japan has acknowledged readiness to strengthen its negotiating stance, but denied any intention to deliberately destabilize global financial reserves. Experts speculate that even partial Japanese bond sales could significantly disrupt the market, triggering concerns about the dollar's dominance as the global reserve currency. Yet many suggest Japan's move is mainly strategic, intended to pressure the U.S. into reducing or removing EV tariffs. In response, the U.S. Treasury Secretary has emphasized dialogue and negotiation, highlighting the importance of mutual respect and cooperation. Nevertheless, U.S. policymakers have also started exploring potential countermoves, including seeking alternative bond buyers and diplomatic outreach to mitigate the financial impact of Japan's actions. Trade war and EV sector focus. The tension between Japan and the U.S. spotlights electric vehicles, an increasingly critical sector amid global environmental concerns. The U.S. has imposed protective tariffs to foster domestic production, frustrating Japanese automakers who accuse Washington of unfair competition. Conversely, U.S. automakers point to similar Japanese protectionist measures, underscoring mutual grievances fueling the trade conflict. Japan's auto industry remains a global powerhouse, consistently innovating in electric, hybrid, and hydrogen technologies. Toyota's advances in hydrogen vehicles, Nissan's expanded electric car lineup, and Honda's breakthroughs in battery technology exemplify Japan's competitive edge. These developments intensify U.S. concerns over losing technological leadership, prompting protectionist measures intended to bolster domestic capabilities. Financial and geopolitical implications. The potential financial fallout extends beyond economic considerations into geopolitical realms. While Japan remains a crucial U.S. ally in security matters, sustained trade disputes threaten this strategic relationship. Washington's Commerce Department emphasizes dialogue to manage disagreements, wary of deeper economic rifts affecting broader diplomatic ties. The yen's significant depreciation against the dollar over recent years, driven partly by Japan's low interest rate policies, has complicated the country's financial strategies. Rising U.S. bond yields have further strained Japan's foreign exchange reserves, prompting reassessment of its bond investments. Continued depreciation pressures Japan's import costs, exacerbating inflationary risks and complicating domestic economic policy. Japan also seeks to protect its broader strategic interests in Asia. Balancing relations with China and South Korea, Japan recognizes the importance of maintaining economic independence from U.S. influence while navigating regional tensions. The bond strategy thus serves dual purposes, challenging U.S. tariffs and asserting regional economic autonomy. Domino effect and global market risks. If Japan continues bond sales, the U.S. may face increased borrowing costs, risking inflation and potential recession. Japan, however, also risks economic backlash through diminished returns from the critical U.S. market. Analysts warn that other major bondholders, including China and Russia, might follow Japan's lead, potentially undermining dollar dominance. European nations, sharing Japan's frustrations over U.S. protectionism in the EV market but lacking similar financial leverage, watch closely. Should Japan's tactics succeed, Europe might reconsider diplomatic approaches toward U.S. trade negotiations, potentially reshaping international economic alliances. Developing nations also face potential impacts. As dollar strength fluctuates, currencies in emerging markets like Turkey, Brazil, and India become vulnerable to volatility, impacting trade balances, inflation, and economic stability. Japan's bond moves thus reverberate globally, influencing broader economic dynamics, possible outcomes, and scenarios. Japan's initial modest bond sales appear strategically calibrated to pressure the U.S. without causing immediate financial instability. However, larger-scale bond sales remain possible if negotiations stall. Economists debate whether Japan's strategy will yield concessions or backfire, harming its own economic interests more severely than America's. One scenario envisions successful diplomatic engagement leading to tariff reductions and renewed trade cooperation, potentially even prompting negotiations for a new U.S.-Japan free trade agreement. Conversely, prolonged economic brinkmanship could escalate market volatility, negatively impacting both economies and straining diplomatic relations. Ultimately, the confrontation over bonds and tariffs could signal the beginning of a new era in global economic diplomacy, possibly prompting broader international shifts away from dollar dependency. How significantly Japan's actions reshape the global financial landscape depends largely on Washington's willingness to adjust its trade policies and Japan's resolve in maintaining pressure. With Japan's strategy still evolving, global markets remain vigilant. The outcome hinges on careful diplomatic maneuvering, strategic financial management, and the delicate balance between economic and geopolitical interests. Japan's calculated financial moves not only redefine its economic relationship with the United States, but also set a precedent that could influence international economic policy for decades.